And if you think about the real estate world, it is quite bipolar at times. Sometimes it's not logical. Because it's not logical, it's good to have a conversation around behavioral economics. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into the cycle of psychology. Yes, I know that sounds maybe a little wishy-washy, but I think it's an important conversation. Did you know that the real estate cycle, which involves buying real estate at the bottom, buying real estate when the market's peaking, looking at real estate when the market's sliding in value, has psychology attached to it? And it's really important to understand how to navigate your psychology with the market itself and its psychology. So today I want to talk about, making sure we don't buy at the peak, making sure we know how the psychology of real estate actually works. Because real estate is really just a game of investment, but investment is also done by other people, and they have a huge influence on what happens to your wealth. So let's talk about it. Let's dig into it. But hey, welcome back, regulars. You know the drill. Play the program at double speed. Get your life back. And of course, all the lessons I've done, all the podcasts I've done are lessons on real estate. Wow, that's all been a tongue twister. I think it's my neck. I've got a bad neck. I can't move my head. I've been to see Chiro Jesus. Chiro Jesus has adjusted me. I've been 3 times to be touched by Chiro Jesus, to be healed by Chiro Jesus, and it has not worked. So I've been now to a Eastern medical professional who does Eastern Chinese, medical activities. And he has stuck something on my neck. It's burning my neck. My neck's burning. And I'm hoping it'll work. Some of these Eastern philosophy, medical teachings go back 2,000 years. I don't know if sticking something on my neck goes back 2,000 years, but maybe it does. Maybe it's just a modern version of sap from a tree in the middle of China that has been put on my neck. But hey, I hope it works, because I would love to wiggle my head around again. It would be nice to not look like Frankenstein. But we don't want you to be Frankenstein. Frankenstein obviously becomes a bit bipolar. And if you think about the real estate world, it is quite bipolar at times. Sometimes it's not logical. And because it's not logical, it's good to have a conversation around behavioral economics. Now, I kind of love the study of behavioral economics. It's kind of a topic I think is pretty cool. That marketplaces behave differently because of people. And I want to talk about that. You know, the psychology of money is different in all of us. If you grew up, and when you grew up, you know, money was considered hard to come by. It might be something that you never got to know. Your relationship with money is 100% different to someone who grew up with a bit of a silver spoon, with money flowing around differently. Beliefs are just part of our journey, and how we approach real estate investment is often belief driven. If you bought stocks in 2008 and 3 months later the stock exchange fell apart because of the global financial crisis, you probably have a belief that the stock market will never make someone money. Our experience form our strategy, and this is one of the challenges with real estate. If we don't bring into the real estate world a correct set of beliefs, a plan, a long-term viewpoint of real estate, we can often have a bit of a short-term love affair with real estate itself. But real estate is a marketplace and it is a cycle, and it goes up, it goes down, it goes sideways. It can lose value. Real estate can lose value. Real estate goes through these different periods. And if you think about the quintessential cycle as a property clock at the bottom, you've got the bottom of the market at sort of 8 o'clock, you've got this rising marketplace. At sort of 10 o'clock, you've got a hot market. 12 o'clock, you've got the peak of the market. Then you've got at 2 o'clock, the slide of the market. And at 4 o'clock, you've got this kind of trough period before you go back to the bottom of the market, which is back down at 6 o'clock. But as the marketplace sort of goes through its value process, as it goes from the bottom to the top, you often see people's psychology change a lot about how they approach buying. This is the most interesting thing when it comes to property investment. At the bottom of the marketplace, where the marketplace is the most despondent, where there's really the most depression at a human level, there is the best maths, the best deals, the best opportunities, the best total return that you can put together in real estate. But there is no belief at the bottom of the marketplace. And quite often, because a bottom of the market situation, property prices are very, very, very good, but belief is so bad, most people don't buy in those marketplaces. When a marketplace leaves the point of maximum opportunity at the bottom of the market, from a psychological point of view, it will eventually reach the psychological state of hope, followed by optimism. At a point where a marketplace is going through optimism, even excitement, more people believe in the marketplace. Because more people believe in the marketplace, aggregate demand of people buying in the marketplaces increases. And as more people are buying in the marketplace, it becomes very euphoric. And because it becomes very euphoric, capital growth unfolds. And quite often, really, the fastest way to make money out of real estate is actually not to buy in a value marketplace. It's to buy in a belief marketplaces. Belief marketplaces go up faster in value than actually the property, which is at the bottom of the marketplace. It's kind of an oxymoron, because the problem with belief marketplaces is just making sure that you buy very, very well. If you overpay because of a fear of missing out, just an emotional state, that is just a psychological state that someone puts themselves in, and it's often pressurized by the marketplace. If you overpay for real estate in a belief marketplace, then you are arguably buying late in the property market cycle and paying too much. And of course, if that psychological state changes, and then all of a sudden the market value starts to drop, well, you can find yourself in a position where you've overpaid for real estate and you are negative equity. Now, as the market drops, as the market slides and troughs, you're going to have to wait a period of time before you restart the cycle again. And it can be quite a long time. So it's quite interesting, because when we analyze real estate is often driven by behavioral economics, belief versus value. Now, I like to think there's kind of three versions of a marketplace. There is pre-belief, there is belief, and there is post-belief. And really what you don't want to do is buy in a marketplace which goes from belief to basically disbelief, which is post-belief. disbelief is not a good place to be. You don't want to be there. And so you could examine different marketplaces around Australia and see where they're at. Now, by way of example, probably the marketplace with the most amount of value in it today is Melbourne. It hasn't grown in 5 or 6 years. Property values are very inexpensive for the against the long-term value of Melbourne. The long-term capital growth rates of Melbourne are some of the best in Australia, but it just hasn't clicked over the last 5 or 6 years. So you can get yourself a cracking deal in Melbourne, but it's probably not going to go up in value until other people believe. This is the kind of concept of behavioral economics. The more people believe in something, it becomes a self-fulfilling prophecy that it will go up in value. Now, take Bitcoin, for example. Bitcoin is really a belief asset. Yes, it can have a certain utility with things like basically a hedge against the Australian dollar. But for the most part, Bitcoin was a value asset, not a belief asset, many moons ago. Personally, I think the last time Bitcoin had value in it was around $30,000 a Bitcoin. Today, it's well over 100, and what's driving it is not value. What's driving it is the psychology of belief. If more people believe in it and more people talk about it and more people encourage other people to believe in it, then that belief becomes a self-fulfilling prophecy, which pushes up the value of the actual asset, a belief asset. And of course, the same can be said in real estate. If aggregate demand believes in a marketplace, that marketplace will go up in value. If more people believe in Byron Bay is going to go up in value. You think about probably the one belief marketplace which will stay in belief for quite a long time will be the Brisbane marketplace. And really one of the reasons why it will remain a belief asset, even though the numbers are less impressive than what you could have bought this time last year or even 2 years ago or 3 years ago, is the Olympic Games. And I often say to people, in 2031, you will get a lot of people late to the party coming to that marketplace full of belief around the 2032 Olympic Games. And arguably, if you want to buy some real estate and you want to sell some real estate, really the A-class investor buys at the bottom of the marketplace. The C-class investor buys at the top of the marketplace, the top of the belief cycle. And really, the person that loses money out of real estate is the person that is the latest person to the party. The interesting thing about the Brisbane market is it's kind of time-bound because of the Olympics. You can kind of probably highlight when there's going to be a point where someone pays way too much for real estate, doesn't buy on maths, just buys on this Bitcoin belief of future value. When they look at really what has happened over the last 10 years, they will be shocked because they have bought a property someone else paid half for. That is the concept of the psychology of the cycle. And again, if you look at the Melbourne market, no one believes in what's going on down there at the moment. Does that create an opportunity? Yes, it does. Will it create instant capital growth? Well, no, it won't, because there's not enough aggregate demand believing in the marketplace to push the marketplace up in value. Will it eventually come? After contraction comes expansion. That is just the way it is. So certainly down the track, there will be belief in that marketplace. And probably the ultimate, position to be in is pre-belief, which turns into belief very quickly. However, that is very difficult to time and no one has a crystal ball. In other words, you could buy in the Melbourne market hoping that the bargain you buy today and the discount you get today, you realize the value in 6 months' time. That's potentially unlikely. It could be 3 years' time before you realize the value of your decision. And that is the nature of value versus belief, a value market versus a belief market. Conversely, today, Brisbane, Perth, Adelaide, a lot of people believe in those marketplaces, primarily driven around affordability. Because more people believe in them, they're going up in value. And again, if you want to make more instant money, those marketplaces are the places to probably go. But how far into their cycle are they before there is a correction against the belief? That is the trouble of being late to the party. And of course, other than Brisbane, which seems to have this defined timeline around the 2032 Olympic Games, the other marketplaces, you have to speculate on when the market leaves belief to disbelief. From where the market goes from, I believe in this, to now, this is absurd. I'm not paying this kind of money. The maths don't math. We locally are disbelieving. And of course, an interstate investor thinks they're right about the marketplace, but they're wrong about the marketplace. And again, that's just the way it is. It happens in every asset class. It happens in the share market. It will happen in Bitcoin. Someone today is paying well over $100,000 for a Bitcoin. Maybe they're paying too much. Maybe the belief will turn into disbelief, and that will correct on that particular investor. So the market has a psychology. Why would someone pay $800,000 for a property that 5 years ago was $400,000? Belief, belief, belief. Someone does not do that on mathematics. They do not do that on value investing. They do that primarily because they have a belief in something. And typically that belief is because other people believe. And there is this concept of missing out, a fear of missing out. And quite often where people get burnt in real estate is they follow other people's beliefs. Market sentiment is not an accurate measurement of value. That is something you need to really comprehend. Value is completely different to market sentiment. So if you want a longer cycle, you become a value investor. If you want a shorter cycle and to make money quickly, you become a belief investor. A belief investor, though, needs to know what they're doing, because you don't want to be the belief investor that ends up putting themselves in harm's way when other people go, I don't believe this anymore. And that creates a contraction of money leaving the marketplace and, of course, it going down in value. Our cognitive biases play a role in how behaviorally we invest. And again, there are not many investors that actually invest on maths, even though that is very much the right thing to do. A lot of people just simply invest on speculation, on belief. They've read something, they've heard something, their friend did something, they're more confident about something, they're overconfident about something. Confidence is not maths. Exuberance is not value. That is just energy. That is just energy. And again, human beings are very good at following other people's energy, and it becomes a self-fulfilling prophecy of growth. But what you just don't want to do is be the person that follows too late in the cycle. Emotions will drive the market. It is sentiment driven. And really, those emotions become a social factor that influence decision making. Again, it's really the game of investment. Now, if aggregate demand is made up of upgraders, interstate investors, downsizers, local investors, first homeowners, you can often track through lending data where belief is happening. And you can see that there's more home loans in a certain marketplace than others, and there's a spike in interest. And of course, that will tell you where capital growth is unfolding. It's just a matter of then discerning, are you too late to the party, or has the party got plenty of time to go? And if the party's got plenty of time to go, then belief markets will make you money faster than value marketplaces. Conversely, though, the ultimate place to be is a value marketplace where you're not paying for someone else's capital growth. You're getting the best yield, the lowest possible purchase price in the cycle point. It's the period of maximum return on your investment, but you just have to put up with the fact that no one knows when the bottom of the market is going to change. You could be at the bottom of the market for 6 months, or you could be at the bottom of the market for 3 years. And for a lot of people, it irks them when they buy a value property and sit at the bottom of the market instead of, in some respects, overpaying for a market which is full of belief, where someone else is getting a result of capital growth. Someone's paid $800 for a property that 3 years ago was worth $400, but the $800,000 property is now worth $900,000. For a lot of people, that is more appealing than finding a property which was $700,000, paying $600,000, and then nothing happening because no one believes in the market. And then you're like, well, what am I doing down here? Everyone's over there. And again, this is behavioral psychology. If I put 50 people in a room and I explain this, most people will actually agree that the value market is the better marketplace. But of course, the instant gratification of market growth really is more appealing to people. And so aggregate demand pushes up value. It becomes a self-fulfilling prophecy. And a good way to remember aggregate demand, if you think about what happened in COVID in most marketplaces, you had the home builder grant, which created a lot of demand for new home building for first homeowners. So what happened to the price of first homeowner real estate? It went up in value. You had a lot of upgraders wanting to renovate their properties and or change property using low rates to find a better place to live. You had a huge amount of buyers come into the market, and it became a self-fulfilling prophecy that property values went up. It's the same context. If everyone believes in Perth, Perth will go up in value. If everyone believes in the Brisbane Olympic Games, the Brisbane market will go up in value. And it's just by virtue of aggregate demand. If people leave the Perth marketplace because they no longer believe in the price value in Perth, Perth will go down in value. If people sell off their Bitcoin because they no longer believe in Bitcoin, Bitcoin will go down in value. And eventually, Bitcoin will go down in value to the point where really it has value again. This is the point. Where is the value starting point of the new cycle of an asset? And again, probably now the value point of Bitcoin, if it dropped that far, would be, in my viewpoint, around 70,000 a Bitcoin. It was previously 30,000 a Bitcoin in the previous cycle. So it has to drop before the value comes back and you become a value buyer, not a belief buyer. Someone else be the belief buyer. So it's just a way to look at real estate and a way to understand psychology. It is all driven by psychology. And if you think about really the idea that a market's very despondent, it's got the most value in it, but it is despondent. It has no belief. So don't stress out if you buy in a despondent market that no one believes in. That's the point of buying in a despondent market that no one believes in. Obviously, a market will go through hope, optimism, excitement, and become very euphoric. When a market is very euphoric, you can be a little bit late to the party. And you've just got to be mindful not to do that to yourself. Now, I've done this to myself. I've bought in a previous cycle on the Gold Coast, not the current cycle, a previous cycle where I bought at a market peak based on really the idea the market was moving so much that I wanted a piece of that. And I jumped into the market and I bought a pretty good little waterside apartment. At the time, it was $380,000. The year I bought, the belief in the market was so strong, it went from $380,000 to $475,000. Thought I was a genius because I jumped on to the belief of the cycle and made myself a bit of money. But then that market cycle, the Gold Coast at that point of the time, and this is sort of in the early 2000s, actually corrected. It went from belief to disbelief and really corrected around the GFC period. When it corrected, that original purchase for $380,000, which became $475,000, dropped to $320,000. And again, at $320,000, which was the drop in value, that was really the value, start of the next value chain of that real estate cycle. So I had to wait it out and pay mortgages and I'd lost my growth because I bought because my psychology and the psychology of others was very trusting of the sentiment of excitement. So now, since then, I typically value invest. I typically have equity. I'm not in a rush to make equity. I don't need equity to fuel my life. So typically I shop as a value investor. I go to a marketplace where there has not been much excitement, nor is there any belief. And that's where I typically buy. But I'm not in a hurry. I've got bucket loads of equity. Other people need equity. So for them, timing a belief market is not a bad move because you get a quicker hit of capital growth. The best way to understand it, belief markets will give you a quicker hit of capital growth if you time it well. Value markets will give you a longer period of capital growth if you time them well. So I hope that's helpful. Just don't be in a disbelief marketplace. That's the worst thing you can do. But that's the psychology of real estate. Talk soon. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.